Well, corporate bonds have had a great year. On average, they're up more than 20%. Compare that to Treasuries, which have had a lousy year, negative return, and the worst year in about 3 decades. So will this trend continue into 2010? PIMCO, the world's biggest bond fund manager, certainly thinks so. We're joined now by the company's global head of corporate bond portfolio management, Mark Kiesel. He's up early at the Newport Beach, California office, and thanks for joining us, Mark. So you think there's going to be outperformance once again for corporates versus treasuries. Give us the thesis.
Sure. Well, I think the thesis is really that what we're going to see in 2010 in terms of net issuance in treasuries is really going to be unprecedented. You're talking about 1.4 trillion of treasuries, long dated, hitting the market next year likely. That's almost 10% of GDP. In terms of corporate supply, you're talking about maybe 0.5% of GDP. So you're talking about a significant increase in treasury issuance relative to corporates. Corporates are also sitting on a lot of cash. In the case of non-financials, over $700 billion of cash, and banks are delevering their balance sheet and benefiting from growing deposit bases. So all that means less need for issuance for companies next year.
What about another factor for companies? You know, obviously Wall Street's coming to them and saying, hey, you want to raise money in the debt market right now, you can. But they've got to be thinking, if we do have decent cash on our books, why would we necessarily raise money to fund whatever acquisitions that we might not even want to do?
Right. You know, that's a really good point, too, because companies have really managed themselves well through this crisis. In the last 10 years, we've really gone through 2 deleveraging periods or recessions. And what's interesting about both, the most recent period as well as the 2001-2002 experience, is that non-financial debt growth slowed significantly. So basically, companies get religion through recessions. They focus on bondholders, they pay down debt, and they use excess cash flow to run the companies very conservatively. That is why when you come out of recessions and these credit spreads are extremely wide, as long as management is managing the company conservatively, it's a very good time to own corporate bonds. And next year will be also, I think, a very good year to own corporate bonds.
Mark, give us some numbers. On average, on Wall Street, strategists would not be surprised to see the S&P rally another 10%. Compare what kind of returns you might see in corporate bonds.
Well, I think, you know, investment-grade corporate bonds should deliver somewhere between, say, 5 and 6%, and high yield is probably closer to, say, 8%. So you're talking about mid to high single-digit returns. You know, historically, that is an equity return. Yeah. And so if you look at last year, corporate bonds delivered 20 to 40%, depending on what type of bond you were looking at. That looks very good relative to equities, particularly because you're higher up in the capital structure. So in terms of where you want to be in companies' capital structures coming out of recession, the top of the capital structure looks very good on a risk-reward basis. So corporate bonds still look appealing. And
as for sectors, I know you're keeping an eye on bank-related bonds. Is that your top sector call?
Yeah, banks should do very well, and what's interesting about it is that banks are delevering very aggressively right now. In addition, there's likely going to be increased need for regulatory capital, which means more equity. Equity goes in below bonds in the capital structure, so it actually makes the company safer from a bondholder perspective. Banks are de-risking and becoming more like utilities, and so as a result of that, that's very attractive for bondholders who are at the top of the capital structure.
All right, Mark, appreciate your time and your perspective on what lies ahead for corporate bonds in 2010. Mark Kiesel joining us from PIMCO.